Financial management, very interesting subject in your ACCA. So let me give you an overview about this particular subject. So if you take this subject, financial management, it has 8 sections. Section A, financial management functions. So in this section they have covered what are the functions of financial management, what is financial management, what are the objectives of financial management. That is section A. Next one is section B, which is financial management environment. So what are the things connected with financial management environment? What are the financial markets? How to deal with macroeconomic objectives? What are the instruments that we can use to manage the macroeconomic objectives, such as fiscal policy, monetary policy? So those things are covered in section B, financial management environment. Next section is working capital management. Very important section for your financial management paper. If you take working capital management section, in this section you will be learning how to manage your working capital. So what is working capital? You know, the funds available for you or the capital available for you for your day-to-day activities, for your business operation activities. So how to manage this working capital? Managing the working capital is very important for a business. So let me take an example. You have $100,000 with you. So why you are keeping this $100,000? For your working capital purpose. That means sometimes to purchase inventory, sometimes maybe to make the payments for your suppliers, to make the payment for other expenditures, whatever the bills that you are getting, and to make the payment for your labors. So for these purposes, you are keeping this cash $100,000 with you inside the locker. Okay. So you just think and see, if you keep that $100,000 inside the locker, from other end you have some kind of cost. So what's the cost? It's opportunity cost. Because rather than keeping that 100,000 inside the locker, you can go and make an investment using that 100,000. Let me take an example. You can go and deposit in the bank. If you deposit in the bank, you will get interest, right? So you are losing the opportunity of earning interest if you keep that 100,000 inside the locker. So let's assume you are going and depositing this entire 100,000 in the bank in the expectation of getting interest. So if you deposit entire 100,000 in the bank, what will happen? From other end, there is a problem in the liquidity because you don't have cash to purchase inventory. You don't have cash to make the payments for your suppliers. You don't have cash to make the payments for your labors and for other expenditures. There is a problem in the liquidity. So you can't keep entire 100,000 inside the locker for your working capital purpose because from other end you are sacrificing the opportunity cost. You have an opportunity cost. The interest you will not be able to earn if it is bank deposit. If you go and deposit entire amount, if you go and invest entire amount, what will happen? From other end, there is a problem in the liquidity. So you should know how to manage these two properly. How much should I have to keep for my working capital purpose? How much I should go and invest? Is it 50,000? 50,000. Or should I have to keep 40,000 for my working capital purpose? Remaining 60,000 should I have to invest? How to manage these two properly? What's the best for the companies? So how to identify that? So that will be learned in working capital section, which is your section C. Next one, section D, investment appraisal. Again, very important section in your financial management paper. In this section only you will be learning how to appraise an investment. It's like this, no? If you want to make an investment, you should check whether that investment is a good investment or bad investment. So for you to check that, what are the techniques that you have to check whether an investment is a good investment or bad investment? So I have to proceed with this investment or not. How to take that decision? So that learning will be given in the section B, which is investment appraisal. Next section, which is section E, business financing. So for you to run the business, you need financing, right? So if you need financing, normally you can get the financing from two sources. One is from equity source, other one is from debt source. What is equity source? Let's take an example. You need $100,000 in order to purchase a machine for the investment purpose. So you need $100,000 for your business now. Are you going to obtain this $100,000 from equity holders, like example shareholders? Are you going to ask this 100,000 from shareholders by issuing some shares? Or are you going to take it from debt holders, like taking a bank loan? So what you have to understand, normally equity holders, they will require some higher return because of the additional risk that they are taking than debt holders. Because equity holders, they will not get a fixed return like debt holders are getting. If bank gives a loan, the bank will get interest every year or every month. It is fixed. Whether the business performs well or not, whether business have profits or not, the bank will get the interest. But shareholders are not like that. Sometimes they will get dividend, sometimes they will not get dividend. So the risk which is taken by the equity holders are higher than the risk which is taken by the debt holders. Since equity holders are taking a higher risk, they will expect for a higher return. Whereas debt holders are taking a lower risk because they know whatever is done, whether business performs well or not, they will get their money. Since they are taking a lower risk, they will get a lower return. So if you take your entire 100,000 that you need from equity holders, in return you have to pay a higher amount. Let's assume equity holders are expecting a return of 15%. Then you have to pay a return of 15% because you want to keep your shareholders satisfied also. No? You can't make them disappointed. If they get disappointed, then your company will go for a 6. You can't make them disappointed. So you want to keep them happy. In order to keep them happy, if you obtain this 100,000 from shareholders or equity holders, in return you have to pay 15%. If you take this amount from debt holders, what will happen? You can get it for a cheaper amount. They will expect only 10% return. Example. So if you take this 100,000 from debt holders, in return you have to pay only 10% interest. So are you going to take this 100,000 from 15% return expecting people, which is equity holders? Or are you going to obtain this 100,000 people who are expecting 10% return, which is debt holders? Obviously, as a business, for you, obtaining the money from the people who are expecting 10% return is more beneficial, right? But the problem is, if you take the money from the debt holders, company's risk will increase. If the company's risk increases, to compensate for that additional risk, your equity holders will demand for further return for the existing amount that they have invested. So there is a problem. From one end, you are getting a benefit. What's the benefit? The cheaper debt. Since that, you are getting some saving. If you take the 100,000 from debt, you are getting a saving because the debt is cheaper. But from other end, equity holders will demand for some higher return for the amount that they have already invested because the company's risk is increasing. Because debt to equity portion, if you take, debt portion is little bit increasing by 100,000. That means company's gearing or risk increasing. So when risk increases, to compensate for that, they will demand for higher return. So you should maintain a good balance between these two also. Okay, out of that 100,000, how much am I going to take it from debt holders? How much am I going to take from equity holders? Is it 50,000 debt holders or 50,000 equity holders? Or 60,000 debt holders, 40,000 equity holders? What's the best for the company? So knowledge required for these kind of things you will obtain in section, which is business finance. And next section, which is business valuation. So in this business, you will be learning how to value a business. If I ask you a question now, there is some company, let's assume ABC company, you tell me the value of that company. Let's assume you are running a business, okay? In your own business, I am asking, okay, what's the value of your business? You will not be able to tell. Then how to value a business? What are the techniques that is available for you to value a business? So that will be learned in section F, which is business valuation. And next section, section G, which is risk management. In this section, you will be learning how to manage your risk. If you take a company, normally in this section, we will be learning how to manage your foreign exchange risk, how to manage your interest rate risk. So what is this foreign exchange risk? Let me take an example. You have to make a payment for your US supplier. Okay. So if the today's rate is low, you will make the payment using that lower rate. If this rate increase in the future, let's assume you have to make this payment in another 3 months time. If your conversion rate increases, then what will happen? The payment that you will have to make in the future also will get increased. So the amount that you have to pay for your supplier is subject to this foreign exchange risk. So how to manage that risk? And the companies will face interest rate risk. What is this interest rate risk? Let's assume today's interest rate is 10%. You need 100,000 loan in another 3 months time. So what's the fear that you will have? Okay, in another 3 months time, when you are going to the bank to obtain the 100,000 loan, what if that rate goes up more than 10%? What if it is 12%? What if it is 13%? Then for you, getting the loan today is better, right? Rather than taking the loan in another 3 months time. Because today's rate is 10%, in another 3 months time, what if it goes up to 13% or 14%. There is a risk. So how to manage this risk? How to manage this interest rate risk? So this kind of related knowledge will be obtained in section G, which is risk management. And final section, which is section H, employability and technology skill. So this is a section that is introduced for all the skills and professional papers recently. So in this section, actually you will not learn anything. What ACCA expecting is, they are expecting to enhance the technology skills of the students. So what they are telling is, before you sit for the final exam, you got to practice in your ACCA platform. You should know all the tools in ACCA platform. You should know all the formulas, how to use NPV formula, how to use IRR formula in ACCA platform. Another thing that they are expecting is for y'all to use the resources of ACCA. Whatever the resources given by ACCA in ACCA website, they are expecting y'all to use it. If you go to work, obviously you have to use Excel. And if you want to know anything, you have to do the research and obtain the knowledge. Likewise, here ACCA, what they are expecting, okay, before sitting for the exam, students should know these things. How to use the ACCA platform properly, how to do a proper research, and how to obtain the knowledge. So you can do a proper research in the ACCA website and obtain whatever the knowledge that you want from ACCA articles itself. So this is what they're expecting is. So you are not learning any subject content related matters. Additionally, what you have to do, you have to enhance your technology skill. So this section, section H, employability and technology skill, they have introduced for all the ACCA papers recently. That means for skills level and professional level. So I hope you got a better understanding of what is this financial management subject is, and from this subject what are the things that we are covering. So if you are expecting to get more ACCA information and knowledge, you can subscribe my channel, and you can press the bell button and keep, so when I post a new video you will get the notification. If you like my video, don't forget to like it, share it, and make sure to subscribe my channel.